Welcome to Daily Wisdom from the Flippening podcast. These episodes feature short, to-the-point clips from our full-length interviews. We talk to the men and women behind the trades, crypto exchanges, and regulations with the goal of helping you become a better, more informed investor.
Hi, I'm Michael Kaplan, editor of the Flippening podcast. Today's episode is from a 2018 conversation with Dhruv Bansal, co-founder and CSO of Unchained Capital, a company that provides cash loans to holders of crypto assets. We discuss why, as a form of collateral, Bitcoin is no more risky than traditional assets. For the full conversation, check out Flippening episode 8. Now, without further ado, our conversation with Dhruv Bansal, co-founder and CSO of Unchained Capital. Enjoy.
On the whole, man, our documents are pretty easy.
How many pages total and length are there, and what percentage do you think you would be able to cut if you weren't doing crypto loans?
If we weren't doing crypto loans and we're doing traditional lending, almost everything that's in there would still have to be in there. There's only a few places that we've really changed the process to specialize it for cryptocurrency. Like, for example, the concept of address or the concept of forks. Like, these are things that are crypto unique, though, so we have a few lines and paragraphs around them. But by and large, like from a legal and compliance perspective, we are an asset-based lender. And our documents look like any other asset-based lenders, and they're about as short and as sweet as you could get if you were doing asset-based lending. They aren't tremendously more complex because of cryptocurrency.
So the vast majority of the wording would be exactly the same if you were issuing loans against someone's house or something like that.
Yeah, I don't think it's a stretch to say that we, in fact, modeled most of those documents on those kinds of asset-based loans, because that really is the category of product that we sell.
What do you think providers of traditional loans, for example, loans against your house, what do you think they envy about your business, and what do you envy about their business?
What do I envy about them? Certainly I envy how they can take for granted people's attitude towards the kind of collateral that they're working with, right?
They don't even read the docs. They're like, all right, I get it. They sign it.
I get it. These are homes. I'm buying a bundle of 10,000 homes. I get it. It's almost casual the way that people regard other kinds of assets, and the scrutiny that they put upon new kinds of assets like cryptocurrency. It's fair. It's absolutely deserved, and it's fair, but it can make life more difficult. So I'm certainly envious of that. I'm also envious of the scale of the market that they're entering. Crypto is a tremendously large market now. It's hundreds of billions of dollars in size, and the addressable market for loans is many tens of billions, I'm sure, within that space. But the addressable market size for student loans in dollars is like, I think, $1 trillion or more. It's just everyone is in the regular loan industry, and still relatively few people are in the crypto loan industry. But that's also exciting, right? That means that we're in early days, and in theory, the ecosystem is poised to expand, and it's all going to be gravy. So that's what I'm envious about. What would they be envious about me? On some level, I want to say the rates, because I believe we offer a very safe form of lending. It's akin to a margin loan in which we're literally holding the collateral or have access to the collateral that we're using to guarantee the loan. It's secured. It's very safe. Our collateral, as I've described, we could obtain more within minutes when we need to. It's automatic and digital. There's no downtime. There's no closed markets. So in that sense, it's a very safe form of collateral, yet our interest rates are 10 and 14%. So there's a premium that I believe lenders are getting for choosing to accept the risk stigma around cryptocurrencies. I believe the actual risk is lower. I'm not saying cryptocurrencies aren't volatile or that there aren't some existential risks associated with them. There absolutely are. And that's, I think, what drives the premium. But I know a lot of lenders who love the idea of 10 to 14% rates and love the idea of quick collateralization and digitally recording the rights to everything and all the cash flows and all the accounting. That's pretty compelling.
So in other words, like if a bank needs to possess a house, that's a very costly thing to do, but they're getting a much lower interest rate. Like you can't just walk in and like possess a house or possess a boat. These are very complicated things to do.
Correct.
Whereas, if someone defaults on their loan, actually selling their Bitcoin is pretty easy.
Yeah, it's done within minutes.
And you make more. One thing that you said to me really stood out, which is you give people access to the address where their Bitcoin is stored so they can monitor at all times to make sure that their Bitcoin, which they in fact own, is still there. Is that correct? They can monitor it, they can watch it, that kind of thing?
That's exactly how it works. I mean, I'm a Bitcoin holder. I'm nervous about storing my funds on exchanges. I don't trust third parties. I trust myself. I trust my hardware wallet. And I recognize that a lot of Bitcoin holders are like that. So what we have today is about as good as we can do as a single organization. You have to trust us. We hold all the keys, but there are multiple keys. It's a hardware wallet. It's cold storage, etc. The reason we display addresses is because since we know that you don't really have any rights to this cryptocurrency when you give it to us, at least from a controls perspective, you have legal rights. In theory, there's nothing preventing our entire company from turning tail and stealing all your coins in some colluding event. And I mean, we would never do it. It's absurd, but you don't know that. And so as a concession, what we like to do is we like to provision a single address that the customer can use when they deposit their collateral, and the collateral will remain in that address the entire duration of the loan. We don't recycle collateral. We don't reuse it to fund other projects. We don't lend out the Bitcoin that you gave us to other people in order to make more money. It literally just sits there and it serves as collateral. You can watch it through our website. You can watch it through any third-party block explorer you want. And it's our concession to you because we understand that you're giving up control.
That's it for today. If you like what you heard and want to support the show, please consider leaving us a review on iTunes, Stitcher, or wherever you listen to podcasts. If you decide to leave us a review after subscribing, we'll send you a free Nomics t-shirt. Just hit us up on Twitter at username Nomics Finance after you've left the review, and we'll hook you up. You may also be interested in Nomics.com, our crypto market cap and pricing website. Check us out at Nomics.com, spelled Nomics. Now stick around for our legal disclaimer. All opinions expressed by podcast hosts or guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions. The producers, hosts, and guests of the show may maintain positions in the companies or assets discussed today.